What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we're looking at Powell's speech he spoke today at the virtual Jackson Hole conference that they have every single year. And so wanted to cover what he said and what impact it's having on the markets today. Let's dive in. All right, so there was virtually nothing of surprise or nothing of new substance that Powell said today. Ultimately, just recommitted to trying to seek higher inflation for a number of reasons. Now, one of those reasons that he stated was because of the jobs market, and the Federal Reserve has a dual mandate by Congress. One of them is stable prices, and the other one is to seek full employment. And so one of the tools that they use in order to try and push America to full employment is interest rates, and quite honestly, this has never worked. In fact, Powell actually acknowledged, I can't remember if it was earlier this year or if it was late last year, but recently Powell even acknowledged that the Phillips curve has stopped working. The Phillips curve is supposed to show the relationship between inflation and employment, that the two are kind of inversely correlated. So as inflation goes up, unemployment goes down, so more people are employed. And quite honestly, it's hogwash. It doesn't work. It's never really worked. There were brief periods of time where that correlation has existed, that inverse correlation, but looking at longer periods of history, especially if you look outside of just the United States, it's garbage. And so and Powell has even acknowledged this. And so the fact that he's using low employment as an excuse to target higher inflation is it's blatantly intellectually dishonest on his part, because that they know that relationship doesn't exist. And even from a common sense standpoint, for the average person who hasn't been brainwashed by studying Keynesian macroeconomics, which is basically voodoo, how does it help you get a job if the price of your groceries and gas and houses go up? It doesn't. On average, if the prices of everything are going up, that doesn't help you get a job, because the reason why prices of, let's say, a car goes up, or your average Hungry Man meal, or a gallon of milk, or a box of chimichangas, the reason why those prices go up is not because the grocery stores or the food manufacturers are increasing their profits, although that does happen over time. The primary reason why the prices of those go up is because the prices of the stuff that it takes to make that stuff goes up. Now, this is one reason why stocks are a little bit of a hedge against inflation, because as the prices of everything goes up, that essentially increases the relative earnings and profits of companies. And so as prices go up, that also impacts the price per share of stocks through their revenues and profits. So over time, there is a relationship there where stocks are at least somewhat inflation protected. But costs going up across the board, from the end product to the raw materials, that does not help employment. And in fact, the long-term history in the United States is that employment, wages, the labor force participation, the employment numbers are going the wrong way. They're not showing signs of a healthy economy. They're showing signs of a breaking and a declining economy. And we've had decades of the same monetary policy. It's not like anything that the Federal Reserve is saying or doing now is different than it's been. It's just more, or a larger magnitude of the same thing that they've been doing. It's trying to stimulate things by lowering interest rates and monetizing debt. It's printing money to purchase debt, to keep rates low, and to inject more money into the system. Now, it's a little bit ironic because, as I've said before, it's they're using the official measures of inflation, and the Federal Reserve has admitted behind closed doors that they know their measures of inflation don't work, and they're still using these measures of inflation, not because they don't have a better alternative, but because they need to be able to print money, they need to be able to monetize debt, they need to have monetary expansion, which is, the traditional definition of inflation. They need that without the price measures showing inflation. So if you go back and if you look at the prices of the stuff that you've bought for your entire life, and you go back and look at the prices from a year ago, 5 years ago, 10 years ago, 20 years ago, you're going to notice that inflation has been running far above what the official inflation numbers have shown. A conservative estimate is, on average across the nation, about 4% per year, but in certain cities, 5 to 10% every single year for decades. And the fact of the matter is the Fed needs inflation without everybody knowing that there's inflation so that they can postpone the debt problem as long as possible. Because as soon as the official inflation numbers show that there really is inflation, interest rates spike. Because lenders don't lend without being compensated for the lending risk. And so if interest rates stay the same while at the same time inflation is going up, that means real interest rates are plummeting. Now, Powell said today that he expects that when inflation goes up, that they're going to let it run hotter than normal, which I believe, because once the official inflation numbers start to really show what's happening, because once the official inflation numbers go up, there's going to have to have been so much money printing that real inflation will be much higher. But to get to that point where the official inflation metrics show 2 or 3%, there's going to have to be a lot more money printing, a lot more debt. The overall economy is going to be in a much more fragile place than it is today. And so at that point, in order to pull back, to tighten that string, to pull in the leash, the pain that would cause is going to be too great for any policymaker to make willingly, because an increase in overall debt levels makes a system fragile. It doesn't make it more robust. Now, it did have an effect on the markets. So as soon as he started talking, the gold and silver started spiking, and then it looked like there was a little bit of a coordinated effort by the trading desks to start unloading throwing a bunch of sell orders onto the market to push the prices back down. Now, gold and silver at this point, they've still stayed above their trend line here. And so if we had that really nice rally in gold and silver, and then there was a steep sell-off, and now they've been consolidating, and it looks like they've both been forming kind of a nice little wedge here. Ultimately, though, this is a nice consolidation. And so after a big move, when you have consolidation, it's very, very healthy from a charting perspective. It represents a coiling back up of energy after you've had a big run. All of the reports that have come out about the net positions of trading desks and hedge funds, the net short position in gold has not improved significantly. And so anytime we hit that lower level, that new lower floor right around that 1900, 1920 mark on gold, it pops again because they start to close out their shorts because they know that's kind of the lowest that it's going to go. And so after this coiling, I expect, a nice another move up. But it did look like we had a little bit of a selling this morning because you don't want gold and silver to start spiking as soon as Powell starts talking about inflation running higher. And so that happened, but it looks like they're bouncing back pretty nicely. And then the stock market started to move up a little bit as well. And so it has continued to kind of move up. And so with the stock market here, kind of odd because it's been trickling up a little bit by little at the same time as the VIX has been moving up little by little, which you don't normally see. You normally see the VIX move up when the stock market moves down. VIX is a measure of volatility, and that VIX number is acquired by using at the money options prices on the stock market. And so that means that the expected volatility in the stock market has been moving higher at the same time as the actual stock market price has been moving higher, which you don't normally see that correlation. You normally see those be inverted a little bit. So we'll probably see some volatility here. We might see a quick sell-off, a retest of those old highs on the S&P 500 here, that 3,400, 3,380 mark on the S&P 500. So I expect that to hold, but we could see some volatility here, a big drop in the next couple of days. We'll see. But that's all for today. Nothing new out of Powell's mouth. They're, just giving lip service to the fact that they want more inflation. And what that really means in reality is they want to be able to print as much money as they want without the official inflation numbers showing what they're really doing. Thanks so much for watching. Have a great day.